Welcome to Iggy's Insights, folks, the channel where we peel back the layers of the economic onion and get to the juicy stuff underneath. I'm your host, Iggy, and today we're diving headfirst into the wild, turbulent, and downright fascinating world of gold. We're not just talking about a shiny metal you might stash under your mattress or wear as a chunky chain. This is about a seismic shift in the global financial system. We'll unpack the hidden forces behind gold's jaw-dropping price surge in 2025, explore what it's screaming at us about the state of our money, and figure out what it all means for you, me, and the world at large. Buckle up! This isn't your grandpa's gold story. It's a roller coaster ride through systemic cracks that could reshape everything we know about finance. Let's kick things off with a little time travel. Back to 1961. When the world's central banks thought they could outsmart the market with a clever little scheme called the London Gold Pool. Picture this, 8 heavy hitters, including the US, UK, and France, teamed up like a financial Avengers squad to pin gold's price at $35 an ounce. Their weapon? Flooding the market with physical gold from their vaults whenever prices twitched upward. For 6 years they held the line, keeping the illusion alive that the dollar, and by extension, the Bretton Woods system, was as good as gold. But by 1968, the cracks showed. France, fed up with America's money printing spree to fund Vietnam and Great Society programs, pulled out of the deal. The pool collapsed, and gold prices broke free like a caged animal. Over the next decade, they soared over 2,300%, from $35 to over $850 by 1980. That's not just a rally, it's a financial supernova. Now, hold that thought, because what's unfolding today feels eerily similar, like history's handing us a remix of that chaotic tune. Fast forward to February 2025 and gold's on fire. It's up 46% in less than a year, leaving the Nasdaq and S&P 500 eating its dust, with those indexes trailing at roughly half that gain over the same stretch. You might think, oh cool, inflation's up, people want a safe haven, same old story. But this isn't your garden variety rally. Beneath the glittering surface lies a darker, more troubling tale. A full-blown liquidity crisis in the paper gold market that's threatening to unravel decades of financial wizardry. The London Bullion Market Association, LBMA, the granddaddy of gold trading, claims there's 279 million ounces chilling in its vaults as of late 2024. Sounds impressive, right? Except here's the kicker. Only 36 million ounces of that, called the float, are actually up for grabs. That leaves us with a paper-to-physical ratio of 7.7.1. Think of it like a casino where they've sold 7 chips for every real dollar in the vault. It's a house of cards, folks, and the wind's starting to blow. To get why this is happening, let's break it into 3 big, messy forces shaking the gold market like a snow globe in a toddler's hands. First up, central banks are turning into gold hoarding dragons. In 2024, they snapped up over 1,000 tons of the yellow stuff, a mind-blowing 1,600% jump from the measly 60 tons they bought in 2020. China's been the ringleader, piling on gold for 17 straight months while unloading $22.7 billion in US treasuries like their last season's fashion. Poland, India, and even Russia are in on it too, each stacking their vaults like they're prepping for an economic apocalypse. This isn't just about diversification, it's a geopolitical power play, a loud no thanks to the dollar's dominance. It's like nations are placing bets on a new world order where gold, not greenbacks, calls the shots. Second, the physical and paper gold markets are splitting apart like a bad divorce. It's like nations are placing bets on a new world order where gold, not greenbacks, calls the shots. Second, the physical and paper gold over in the West, places like the LBMA and COMEX have been playing a high-stakes game of paper promises for years. Contracts settled in cash, not metal. But the Shanghai Gold Exchange is rewriting the rules. They're all about physical delivery. No funny money allowed. If you buy a contract, you're getting bars, not IOUs. This has sparked a massive arbitrage game. Traders scoop up cheap paper gold in London or New York, then flip it for a premium in Shanghai's physical market. The result? COMEX warehouses are bursting, up 300% since 2022, because everyone's rushing to cash in on that sweet, sweet premium. It's like finding a coupon for free pizza in one city and selling it for cash in another. Except the pizza's gold, and the profits are in the billions. Third, we've got delivery defaults looming like storm clouds on the horizon. Right now, COMEX contracts demand delivery of 28% of its registered gold inventory. Problem is, there's not enough shiny stuff to go around. The LBMA has been playing a risky game called rehypothecation, fancy talk for lending out the same gold bars multiple times. It's like a library with one copy of a bestseller that's been promised to 10 different readers. When those readers all show up at once, the librarian's in big trouble. In January 2025, reports surfaced of 4 8-week delays in physical gold deliveries from London vaults, way beyond the usual 2 to 3 days. That's not just a hiccup, it's a technical default screaming that the system's overstretched. If demand keeps spiking, this paper gold bubble could pop spectacularly. Let's zoom in on that rehypothecation mess with an analogy that hits home. Say you've got a prize vinyl record, let's call it a mint condition Beatles White Album. You lend it to your buddy Dave, who secretly lends it to Sarah, who then pawns it off to Mike, and so on. On paper, 5 people think they own your record, but there's still just one disc spinning. Now imagine all 5 show up at your door demanding it back. Good luck, right? That's the gold market today. Too many claims, not enough metal. And when the music stops, someone's getting left out in the cold. This isn't uncharted territory, we've seen this movie before. Flashback to 1971, when Nixon slammed the gold window shut, ending Bretton Woods. For decades, the US had printed dollars against a finite gold stash, promising $35 an ounce to anyone who called their bluff. When foreign nations like France started cashing in, the jig was up. There wasn't enough gold to cover the tab. Today's $95 trillion global debt bubble makes that look like pocket change. Back then, it took a decade for gold to hit its stride. Now, with instant markets and global panic, the reckoning could come much faster. But let's rewind even further for another gem of a lesson. Black Friday, 1869. 2 Wall Street sharks, Jay Gould and Jim Fisk, tried to corner the gold market, buying up every ounce they could while spreading rumors to drive prices skyward. They nearly pulled it off. Gold hit $160 an ounce, a fortune back then, until the U.S. Treasury dumped 4 million ounces into the market, crashing the price 20% in a day. Hundreds of speculators went bust, and the economy took a hit. The twist? That was a physical market with real gold sloshing around. Today's paper gold game is way more leverage. Imagine if Gould and Fisk had 7.7 times more IOUs than actual bars. The fallout would have been apocalyptic. So where's this runaway train headed? 2 paths loom ahead. Scenario 1. The paper gold market implodes under its own weight. If delivery defaults pile up and trust evaporates, prices for physical gold could go parabolic, while paper contracts turn into wallpaper. Think 1970s style chaos, but on steroids, maybe $5,000 an ounce by 2026. Scenario 2. Central banks step in with a monetary reset. Picture a gold standard 2.0, not full backing like the old days, but gold as a reference point in a basket of currencies, or even digital assets like a gold-pegged stablecoin. The IMF's been tinkering with special drawing rights, SDRs, for years. Maybe they dust those off and sprinkle some gold dust on top. Either way, the days of fiat free-for-alls could be numbered. For you investors out there navigating this mess, it's time to get tactical. Physical bullion, bars, or coins stored somewhere safe like a Swiss vault or even a secure spot offshore is king. It's the real deal. No middlemen, no promises. Just metal you can hold. Bitcoin's also flexing its muscles as digital gold. Finite supply, no central control, and a hedge against fiat madness. Mining stocks are another wild card. They're trading at historic discounts to bullion prices despite gold's record highs. Companies like Barrick Gold or Newmont could see monster gains if this surge keeps rolling. Think of them as the picks and shovels of a modern gold rush. But let's not kid ourselves. This isn't just a rally to cheer about over beers. It's a red flashing warning light of systemic failure in the frameworks that have held global finance together since World War II. The ripple effects will hit everything. Central bank policies hashed out in smoky rooms, government scrambling to prop up currencies, and everyday folks just trying to keep their savings from melting away in a sea of inflation. It's like watching a dam crack. First a trickle, then a flood. The question isn't if these changes are coming, but how fast, and whether those caught flat-footed will still have a financial lifeboat when the waters rise. One more historical nugget to chew on. The 2013 gold crash. Prices tanked 15% in 2 days, $1,550 to $1,021, after a flood of paper gold hit the market, spooked by Fed tightening signals. It was a brutal reminder that paper can drag physical prices down in the short term. But here's the difference. Back then, physical demand eventually stabilized the floor. India and China scooped up bargains like Black Friday shoppers. Today, with central banks and physical markets driving the bus, paper's losing its grip. The 2025 surge feels less like a hiccup and more like a tectonic shift. Thanks for riding this crazy train with me through history's lessons and today's headlines, connecting the dots to see what's barreling toward us tomorrow. If this deep dive into gold's wild ride sparked some brain cells or stoked your curiosity, smash that subscribe button so we can keep unpacking the economic chaos together. Drop a comment below. Tell me your take on gold, your predictions, or just say hi. Until next time, keep your eyes on the markets and your feet on solid ground. This is Iggy signing off from Iggy's Insights.